what we are going to do is a simple portion, very easy. Some of the terminologies which are very common with the new issue market. Okay, so yesterday we learned about the issue, the issues, the kinds of issues in the new issue market. In our today's discussion, we would be discussing about some of the concepts, some of the practices which are prevailing in the new issue market. Okay, to begin with, to start with, the first one is book building process. Yesterday in our discussions, we had discussed about certain aspects about book building, and in that we had said that normally the pricing in a primary market can be of two types. One is fixed pricing, or the second one is book building process. So in case of fixed pricing, the company is not giving the chance for the investors to price the share issue of the company, to price the share of the company. Shareholders does not get a chance for pricing. Instead, they are just saying that, okay, we are going to sell the share of this company at, say, so and so rupees, maybe 500 rupees, 600 rupees, 1,200 rupees. They're just saying that. And if you are interested, you can subscribe to that. So that is the case of fixed book building, fixed pricing. I mean, not book building, fixed pricing. Now, in contrast to that, the other one is book building process. Okay, where the company gives the investor an option to go with the, or to prescribe to the issue of this company by, to prescribe to the issue of this company by quoting a price. The company gives the investor, interested prospective investor, a chance to quote for the company share. So when you are given with a right to quote for the company share, it is given like you have a floor price, you have a ceiling price that will be specified by the company. You cannot put anything under the sky. It's not like that. The company, based on its worth, its assets, its possibilities in future, they will fix a floor price. Floor price is the lowest price. So there will be a price band. Between that, the lowest, starting with the lowest, the investor can quote anything up to that ceiling price. So for example, if the company had gone with 720 as the floor price and 1,200 as the ceiling price, then the investor can quote from starting with 720 till 1,200 in between. So maybe you can say as 850 or you can say as 950. So that process in which the investor is given with a price band to quote for the price of the share is in that process, or that process is actually called as book building process. Okay, so you're given with a price band during a public issue. So if you just take up the NSE or BSE website, you can see the forthcoming issues. And in that forthcoming issues, towards the right end, they would have been given, is it fixed pricing or book building process? So if it is fixed pricing, no option for us to quote for it. It's fixed. If you want to buy the shares of that company, you have to pay that money. But in case of book building process, they will say this is the price band. Within this price band, you can go with subscribing or quoting to the share of this particular company. So that price band will be having a floor price and a ceiling price, right? And now the next question is, how does the company go with final awarding? The company will actually take up the weighted average of highest quoted price and the number of shares you have asked for. They will consider these two factors, and finally a price would be fixed by the company and the bid will be closed. In India, normally the book building process, the bidding process is open for 5 days, 3 to 5 days. Within that, the company will close it, and the offering price is based on the highest quoted with weighted average compared with the number of shares quoted for. So this is book building process. And the book building process starts with appointment of a merchant banker. A merchant banker is a specialized agent who is into issue management activities, who facilitate the issue management activities of the company. Normally, this merchant banker will be an organization. Okay, that organization which is into issue management activities will be appointed as a merchant banker, and he will be called as the book runner. In this case, because it is the book building process, he will be called as the book runner. And we know that draft prospectus is issued. In this case, the draft prospectus is called as red herring prospectus. Yesterday we learned that it's called as the red herring prospectus. And the issue will specify, that is, when you are advertising, you will say, okay, we are going to issue 50,000 shares in the market within the price band of this. So that number of shares to be floated in the market will be specified by the company at the time of advertisement itself. The lower end of the price range is called as the floor price, which I have already said. It's called as the floor price. And the higher end of the price is called as the ceiling price. So this is actually the book building process. Now what happens? The syndicate member, the company would have appointed a syndicate member, which can be a financial institution, financial services institution, who would be taking care of receiving the orders from the prospective investors. And then the book will be open for 5 days. All these will be recorded in the book. All the offers received for the company will be recorded in the book. And then the investors will bid their price along with the number of shares. That is, sometimes if I'm going to subscribe to that issue, what I'm going to say is, okay, I'm ready to purchase the share of this company at 720 rupees, 4,000 shares, or 1,000 shares. So this is my bidding. 1,000 shares at the rate of 720. Maybe another investor would have bid as 500 shares at the rate of 810. So that is his bidding. It goes like that. Okay. And then final price will be determined by the issuer. Who is the issuer here? The company which is coming up with the book building process. And to all the successful persons, the shares will be issued. Now the successful person definitely would be, suppose if the bid is fixed at 820, anybody who quoted less than that will not be given with that share. Why? Because he or she said, I'm willing to pay only 720 rupees. Or then somebody said, I'm willing to pay only 750 rupees. So he is not ready to go with if the price is fixed at 820. So all those people will lose that. And then everybody who was ready to buy it at 820 or higher than that will be given with pro rata allotment based on the number of shares. Pro rata means proportionate allotment will be made by the company. That's how it generally happens in the market. So this is all about the book building process. Now what you have to remember here is book building process is a case where an investor is given with a chance to quote for the price of the company. So little more towards a democratic concept. The company is offering an investor the right to quote for the price of the company. Of course, the floor price and the ceiling price will be fixed by the company in consultation with the SEBI. Okay, so that's it about book building process. Now the next concept which we are going to learn is ASBA, application supported by block account. It's a comparatively new concept which has been introduced by SEBI for facilitating the investors who are investing their money in the shares of different companies. Like for example, before that, what used to happen here is, see, I will tell my experience. I had some investments before bringing this concept also. So what happened here is, we might be saying this earlier case itself, we'll take the example. We will be subscribing to say 1,000 shares, okay, 1,000 shares of this particular, any company, paying, bidding at maybe 800 rupees or 820 rupees, 1,000 shares. So literally what happens here is, when the issue being allowed, suppose if the price is fixed at 800, I'll be given with, but maybe the chances of me getting 1,000 shares are less, because there can be high demand for this particular company, and I will be given with only 500 shares. So the money I had paid for 1,000 shares will be blocked till that time over there with the company. it will be a huge amount. Suppose you imagine if the company is going with 820, you can just understand how much is 820 into 1000. That much money is blocked with the company with no interest. So this was the problem that was faced by the investors. And when the company makes the allotment, what happens here is I get only 500 shares. So the remaining money, I have to wait till the company repay it to me. So that takes a lot of time, maybe 6 to 7 months. So to avoid this problem of getting your money blocked with the company, with the bankers to issue, SEBI has come up with a concept called ASBA. ASBA is actually a category of account that is opened by a bank, and this account is designated for your purchases connected with equity shares or financial instruments. So what you can do is you can deposit the money here and that. Based on the allotment, the company will be taking the money from your account. The remaining will be there. There is no condition of repayment, no case of giving it back or getting your money blocked over there for some time. Nothing will happen. As per the allotment, I have made application for 1000 shares. Maybe I'm getting only allotted with 500 shares. So the company will be taking only 500, the money for purchase of 500 shares from my ASBA account. But at the time of application, I have to ensure that there is money enough to buy the subscribed amount by me. That is, I have asked for 1000 shares, 1000 shares. The money for purchasing that should be deposited with this ASBA account. It's actually an ordinary bank account, but it has been designated with this tag that it is used for purchasing of securities. So that is why I have no problem of getting my money blocked till the allotment of shares. So that is the benefit of this ASBA account. That is application supported by blocked amount for applying to the issue in the primary market. An applicant's bank account does not get debited until the shares are allotted to them. So whatever amount being debited, whatever is the amount of shares that's been, what amount is incurred for the shares that been allotted to me, only that will be taken up from my account. The rest of it will be lying in that account, which I can use for any other purpose, maybe buying for some other company. So the problem of getting my money blocked with the company or the bankers to the issue is avoided through something called as ASBA account. Okay, where I just have to ensure that the money is there in my bank account, and then if I am allotted, in certain cases I may not be allotted also. That's the thing in that. So if I am allotted, whatever be the amount for the shares being allotted to me, only that will be taken up from my account. The remaining, the money will be lying in my account. So I'm not losing any interest. I'm not getting my money blocked with the bankers to issue because of subscribing to the issue of some company. So this is the benefit of ASBA account, application supported by block account. Right? Now the third concept which we are going to learn in our today's class is ESOP, Employee Stock Ownership or Employee Share Ownership Scheme, or it's sometimes referred to as Employee Stock Option Scheme. Okay, and I would tell about the history. Infosys was the first company to introduce this concept in India in 1981, where they gave almost 50,000 crore worth shares to the employees who had been there with them since inception. Inception is from the time when the company started its operation. So they gave that much share to share is actually a unit of ownership to their employees as a recognition for their services. So that's all about the concept of ESOP. That is, you are making your employees owners to the company. You know that there will be a difference in the kind of treatment which it's actually a psychological perspective. Some people, maybe they do it honestly, but most of us are into the category that we will give little special care to those assets being owned by us. We will give little more protection, additional care, When you just consider with those assets which is being owned by somebody and you are just working towards it for a salary. Maybe some of us will be working honestly, but there is a general kind of human tendency to give the special treatment to the assets we own. Right. So that is the psychological perspective that's being used when employees being given with this ownership in their companies. The share being issued to the employees and making them owners of the company as a recognition for their services. That is all about employee stock ownership scheme. Okay, so companies employees own shares in that company. They are given with an option. Sometimes they will have to pay a nominal amount, sometimes it's given as a bonus to them, no, for their services with the company. And the employees acquire shares through an share option plan. Okay, and such plans may be selective or it can be to all employees. No, normally what happens here is those people who are in the higher cadre, in the management level, when lower employees go with bonus issue, that's how it happens normally in a corporate. When the higher cadre, like directors or vice presidents or managing directors, they would be going with the concept of this ESOP. They would be given with share in the ownership of the company, right? That's how we do. But Infosys did for everyone. At that time when they gave it for everyone who was there with the company since its inception, not considering the rank. The lowest employee also got a share of it. So that's how it was executed. But this is the concept of employee stock option scheme, where employees get a chance to, it's an option, okay, share option plan, where they get a chance to become the owners of the company, sometimes by paying a nominal amount. Okay, so this is employee stock option plan. And the next term which we are going to learn in our today's class is green shoe option. Okay, green shoe option. This is actually the name of a company which had started this concept for the first time in 1990. Now, the company is still there with a different name, but this name came up from the name of that company. Okay, this is the word meaning is over allotment option. That is the concept meaning is over allotment option. Like here in this case, in addition to the originally offered shares to the underwriters, they are given with an option to take up additional shares if the need arises. That's why I have put they get a chance to buy additional 15% of company share at the offering price. At the offering price, that is at the price at which it is issued. So underwriters, suppose if the issue is overly subscribed, if it is huge demand in the market for the company share, and then it's listed in the market, there is huge demand in the company share. So what happens here is the price of the company share may fluctuate very frequently. Demand is huge, and it is actually moving towards the upper trend. The price is increasing. So if it has been originally written in the agreement with underwriters that they have this green shoe option, the company can use this at the time of that fluctuation, or what the fluctuation is what we call as volatility. At the time of that volatility, to make the underwriters purchase that additional lot. And what the additional lot being purchased by underwriter, what do they do with that? They might be selling that in the market, or they might be making that available in the market. So the number of shares available in the market has increased. Automatically, the price fluctuation will come down slowly. It will be this 15% in a way is helping to stabilize the price movements in the market. So in nutshell, if you ask me what is that, it's nothing but underwriters are given with an option to purchase in additional to what they have been promised in case of need. And that additional is quoted to be 15%. But the condition to be satisfied is it is to be returned at the original agreement when the offer was made to the underwriters. Now we know who are underwriters. Underwriters are those people who have agreed to take up the company shares in case if it is not subscribed by the public. Suppose the company, if the company receive minimum subscription only, in that case, the underwriters will come to help the company. Or else a portion of company shares are held separately to be subscribed by the underwriters. We have learned that different types of underwriting and all. I'm not going again back into that, but I'm just revamping what is the concept of underwriting. So green shoe option is a additional option given to the underwriters at the time of agreement for getting over allotment of option. Why it is called as over allotment? It is over and above the allotment, the fixed allotment of the company. The company initially might have said that we are going with 50,000 allotment of shares, but then if this clause is there, they can go with 65, allotting that 15% to the underwriters. So already they're fixed with 50,000, and what happens here is, in this case, they go with increasing the number of shares allotted by giving that 15% to the underwriters. Okay, so that is over allotment option given to the underwriter. That is what we call as green shoe option. Okay, I had one more option to be discussed, but I think I will take that to the next class. So in our today's class, we discussed about primarily 3 concepts. The first one which we discussed was book building process, which talks about a price band, where the investor is given with a price band in which he or she can quote the price for the company. And the highest bidding price, giving due weight to the number, will be fixed as the final price for the allotment of the company's shares. And then we learned about application supported by blocked account. This is a facility introduced by SEBI for making it convenient for the investor to subscribe to the shares of different companies. Then we learned about ESOP. ESOP is Employee Stock Option Program, which is basically employee given with an ownership in the shares of the company as an additional or as a recognition to the services for the company. And the last terminology which we learned in our today's class is green shoe option. It is over allotment facility that is given to the underwriters if that is mentioned in the agreement.